Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Fiscal year 2024 was a good year for the share market and a good year for super funds, the second year in a row of very strong returns. Can they make it three? My guest today is Dan Farmer, Chief Investment Officer at MLC Asset Management, overseeing MLC's broader investment strategy and the bulk of Insignia's financial funds as well. MLC's MySuper growth portfolio delivered a near 10% return for the last financial year. Remember, this is general information only and you should always seek professional advice before making investment decisions. Dan, welcome to Fear and Greed.
Thanks for having me, Sean.
So let's look past first. What was last year all about? A near 10% return. That's pretty good.
Yeah, good return, Sean. And look, we're really happy for our members because 10% return is a strong absolute return. And I think, in a period where inflation's been high, super funds and our fund in particular delivered a return well above the rate of inflation. So that's helping our members drive those real returns. I think the year itself, a really interesting return. I think if you wound the clock back 12 months, I'm not sure that many funds would have been expecting such a strong return. So it has been a really, really good year. Quite a few things have driven the return. I think the way we've built our portfolio has been quite unique. We really focus on diversification and really robust portfolios. So I've been running these sort of portfolios for 30 years, and one thing I've found is diversification is really key. So when we look at what actually drove performance over the year, it's been a whole range of factors. Not one single position's been the key driver. So in our portfolios, we've had some really interesting drivers of return over the year. We really try to run a quite differentiated alternatives program. So alternatives are those assets which we're looking for a really strong return from, but behave very differently from other asset classes. So their return's not driven by what happens in the equity market or what happens in the fixed interest market. So we've had some strong returns out of what we call our insurance-related investments. So these are investments where we actually take some sub-underwriting or some reinsurance risk off the big insurers, and we get paid for that, and our members receive that return. So that insurance-related investments last year in our portfolios returned 16%. Really strong return and uncorrelated to other asset classes. And it's interesting to look at what's driving that those insurance-related investments are really taking weather risk, so Florida hurricane risk, and taking some very remote risk of large hurricane events hitting Florida. And we've been getting paid 16% returns for that risk over the last year. Really interesting space. It's been starved of capital. A lot of capital's exited that space for a whole range of reasons, and that's resulted in really good returns in that space. Probably, Sean, the other couple of key things, private credit markets, which have been very topical in recent periods. We've been really quite nimble with our private credit exposures, and we're finding parts of the market starved of capital. So we've got a really experienced team that's sort of really scouring the market, looking for those opportunities in the area where capital's been removed. And, we're getting very attractive returns there as well. So again, alternatives, 11% return out of some of these opportunistic private credits. And to give you an example of the sort of areas there that we're finding, commercial property, so office space, has had a pretty challenging year, but we're starting to find some niche opportunities where there's some really attractive, slightly distressed assets in the commercial property space. So finding some private credit opportunities in Northern European commercial property. So some really interesting niche things driven returns. I guess probably one of the big ones has been equities. Again, if you wound the clock back 12 months, listed equities, we were facing into a pretty challenging environment. Recession risk looked pretty high. It was kind of tempting to be underweight listed equities, both international equities and Australian equities. We avoided that and stayed neutral equities, and we actually got a really good active return through our active managers. It's been a tough year for active managers. So when we invest into listed equity markets, we look for the best external managers out in the marketplace and really ask those managers to outperform the index. So through really being active in what stocks they select, looking for them to beat the index after fees. And we've been, had a really good year there. So our international equity managers, outperformed the index by, around about 2%, which was a really, strong result in the year. So even though international equity markets dominated by tech, Nvidia, the big tech shares, really driving a lot of that return. Our active managers, had some exposure to tech, but found a lot of other opportunities to drive the return over and above tech over the year. So, Sean, a whole range of factors driving those good returns.
Okay, just a few things I want to delve into that. The fact that you're talking about taking on reinsurance risk, I suppose one of the reasons you invest with MLC, me as an individual, puts money with a institutional investor like MLC or many of your competitors, as opposed to a DIY, is that you can actually get exposure to asset classes that you probably never would do otherwise. I mean, reinsurance risk is a good example.
Yeah, and it's a really specialist space. So again, it's something you need to go in with a really good knowledge base, really good transparency on what you're actually investing in. And it takes a massive amount of work. So, in our case, and we have a team that's been in that alternatives reinsurance space for coming on to 18 years. So this is, success doesn't come overnight. It takes a long time to build up that skill. And of course, we, like most institutional investors, really demand a high level of transparency, really deep dive onto those assets. And climate change comes up as a discussion point around those weather-related risks. And, a lot of work being done on that. And when we analyse those risks, we see that we're being overcompensated, we think, for the weather-related risks that we're being paid to take on.
Stay with me, Dan. We'll be back in a minute. I'm speaking to Dan Farmer, Chief Investment Officer at MLC Asset Management. Okay, so it is all about risk reward here. It's not one or the other. They come together. What about going forward? You mentioned you think there are opportunities in commercial office space in terms of how your funds are positioned today, mid-July. What are you where is your bias towards?
Yeah, sure, Sean. And I think, look, just on the commercial office space, we probably think it's still a little bit early to go back into office investment wholesale, if you like. We're rifle shotting specific opportunities, but there will be a time where that's the case. I think going forward, there's some really interesting returns. So, as you said, it's been 2 good years in a row. We'd love to make it 3. A lot of that will depend on what equity markets do. And look, trying to pick an equity market from year to year is, I've been doing it a long time. That's a very tough call. But we know through the long run, those equity markets deliver strong returns, and super funds in general have delivered strong returns over 10-year periods. So the year ahead, we're staying relatively neutral on our equity positions. So we're not overly positive, but we're not overly negative. We can see a range of scenarios going forward. So equities were relatively neutral. One area that we have been building is our global private credit exposures or investments in global private credit. A really interesting space. There's been a lot of talk about private credit. We've actually been an investor in Australian private credit for many years, and that's been a really successful investment for our funds and our investors. Large institutional investor like us, we really demand a lot of transparency, looking through the underlying assets to make sure we're very comfortable with the high quality assets we're taking on. Global private credit's an area we're growing, so we're looking to invest sort of up 3% plus into global private credit. Really attractive returns we can see going forward, sort of around about 12% returns we're seeing. There has been a lot of capital go into the private credit space, and when I say global, I'm really focusing on US and some European private credit. But we see a really good opportunity. The banks have been exiting that space. There's still a really high demand for capital there, and we're seeing returns of around 12% for really high quality underlying credits. So we think they're for us going forward, build out that space, really good opportunity for 12 months, focus on high quality investment managers, really managers that have been around a long time. We've seen a lot of new private credit managers emerge over the last couple of years that have sort of set up relatively recently. We're really looking for well-established managers who have really got the wherewithal to do a lot of deep dive research on the quality of the credit. So private credit is an interesting space for us. And traditional, some areas that are maybe more boring but are coming back into vogue, sort of just government bonds and what we call duration.
Who would have thought a government bond could be sexy? But there you go.
They're coming back. So they're starting to. They're playing the role that they've sort of historically played in the portfolio. They're offering 10-year yields at sort of 4.3% as we sort of record today. Relatively attractive, but also offering that sort of diversification and defensive qualities. If we do see a crack in equity markets or growth, really economic growth really slow down, we typically see money rush towards those government bonds, and you get strong returns. So they're both giving us a return and also that defensive quality in our portfolio. So good old-fashioned bonds and duration starting to play a bit more of a role in the portfolio again.
We're almost out of time, but I just want to quickly go to your point about active management. I think in the flow of ETFs, although there are a lot of active ETFs now, but certainly there's a lot of money going into passive investing, no doubt about it. There is a real argument, though, that now is the exact time to go active, simply because the world has changed so much and the interest rate environment's changed so much.
Agree. And look, we see a role for passive, so we're certainly not in the case that there's no role for passive. There's, passive can play an important role in portfolios. But we really strongly see, as you say, a particularly good case for active management at the moment. There's a lot of concentration in equity markets. We've seen tech stocks really dominate a lot of the return in the US. Our active managers, and I think active managers broadly, should find a pretty rich hunting ground for opportunities where you do see, interest rates pivoting from tightening to easing. We're seeing sort of new industries arise, and we think sort of a greater dispersion in returns going forward. So it should be a relatively happy hunting ground for active managers going forward. And look, our funds have benefited from active management after fees, which is really important for a number of years. So we're remaining committed to active management in large parts of our portfolio.
Dan, thank you for talking to Fear and Greed.
Thanks, Sean. Thanks for having us on.
That was Daniel Farmer, Chief Investment Officer at MLC Asset Management. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.